Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Monday, April 21st, 2025. Today's episode begins with the headline of the day, Leading Index Falling Further. When the Conference Board Leading Economic Index is falling the blue line, it tends to foreshadow a recession pretty accurately. Pretty much every time. Ever since 2022, the leading economic index has been collapsing, and it fell even further today to a new low, notably below the COVID crash low. The black line has not turned over yet. This is the coincident economic index. We know when this is going down, we are in the recession, and we are not actually in the recession exactly yet, according to this metric. The leading economic index are these 10 things right here, and the coincident economic index are these 4 things here, which have not collectively seen a major cool-off yet, being payroll employment, personal income, less transfer payments, manufacturing and trade sales, and industrial production. So while those areas have not gotten hit yet, the leading economic index is still falling here. More specifically, there are really 3 major categories that are driving this lower month over month for March, being the S&P 500 dropping, obviously contributing to the downfall of the leading index, but we also have average consumer expectations for business conditions falling and ISM new orders index. This is probably the most reliable out of those 3, the new orders. This is what businesses are doing. They're ordering less stuff for making stuff. And then if we take a look at what's been driving this over a 6-month period, you can see that the biggest drivers here are those 2 items, the consumer expectations for business conditions and ISM new orders. The leading index falling further is not saying that, things are looking peachy, quite the opposite, adding to the bear case. Moving on to the community topics. I'm sorry about the broken live link. It's a common YouTube glitch that I've experienced before. The last time this happened, it resolved itself eventually. It wasn't a very good show anyway, so you didn't miss anything. Although I did mention that Bitcoin was looking like it was going to break out, and it ended up being correct. It broke out to the upside today. Not hugely, but a little bit. Next on the community topics, I'm going to continue this theme until I get sick of it. What moves, if any, did you make today? Robschild adds to gold short position GDXD. And I actually would have added more if I had any free cash, but I have no cash because I love my positioning so much that I can't imagine something better to put my cash in right now outside of the positions I already have. Coming up, besides flash PMIs and the weekly initial jobless claims, which I'll only bring up on the show if they come out as being very interesting, the most interesting thing coming up is the continuous tariff updates. The United States president seems to be getting a little more angry than I thought at the Fed not willing to cut rates here. While the Fed Powell basically said in a nutshell that he said it without saying it, that, for tariffs, you want to put them piece by piece, not hit it with the largest possible hammer you can possibly hit it with and then see what happens, because what can the Fed do here? Unemployment is still low. Inflation is not at the target yet. And so I don't want to be involved with the whole political side of things. Just in the sense of that, if you want your country's central bank to have any kind of decent reputation, they can't be knee-jerked around. They have to see the data and react to it. And unfortunately, it does lead to the reality that they indeed are always behind, but that's how it's supposed to work. it's a ship that you turn and then you wait to see what happens. You don't, just keep turning back and forth like a crazy person because you're not sure where things are going to go. It's a slow moving vehicle, and it's operating in my view the way it's supposed to. Again, I see the relationship between Powell and Trump as being frenemies with benefits, as I've talked about in numerous previous shows now. Just to show an illustration of how I see this that I think is very valid. The stock market's going down. Trump and Powell are angrily pointing fingers at each other while shaking hands, knowing that rates have to go down eventually. We'll get onto the charts in a moment. Before then, thanks for watching, subscribing, commenting, and supporting. It's really great not feeling alone on this investment journey. These are the daily reminders in macro view. Check the description for the link to my website that explains all of these daily reminders. Two small changes. The leading indicators is now updated to April and still falling. And also the S&P 500, as the price has been waffling around going down, we have PE and CAPE ratios dropping while dividend yields obviously relatively rising. But this is also while treasury yields are actually higher, and so they kind of cancel each other out as far as fair valuation goes, comparing straight up yields on guaranteed securities versus the valuation of stocks right now. Eventually I might add a website or change this to a website, but for now the crystal ball ratings actually still remain the same, and my portfolio is the same other than adding more to a short-term position, adding to the gold short here. On to the charts, starting with SPX, the S&P 500. Lots of charts lately to me have just been looking like just such a beautiful pattern, like you could almost see a bouncy ball bouncing down the stairs, and it just looks like it's going to continue at this point. Very controlled, actually. I always like to look at what's going on with junk bonds because these can really act as the legs to the market. Higher risk debt, when it gets more expensive, it can take the legs really out of the market, and this pattern right now is not looking very sturdy or very bearish. With today's red candle after Thursday's up day, it's not looking weak. It looks like to me it's going to keep going down. This will obviously benefit my put positions. If I didn't think it was going to keep going down, I should probably get out of them now, and I am still holding them. So I am betting that this will continue lower. The VIX, the fear index, the pricing of options contracts, still highly elevated at 33. Whenever it's above 20, we are in panic mode, and we are very, very much in panic mode in sort of a consolidation. It should not be surprising to anyone if we get another big leg up, maybe even a higher high in the VIX in the near term. TLT, my favorite place to be, still wanting to play around in this gap fill. I thought we were done after we dipped down into it, but we dipped back into it today. If I'm able to free up some cash from my short positions, which I hope I'll be able to do sooner than later, and if TLT is still in this range, I'll be obviously putting as much money as I can into probably a combination at this point of ZROZ and TMF. As I mentioned earlier in the show, it was Sunday night. I talked about how my spidey senses were getting the feeling that this is about to break out, and I actually thought it would break out to the downside, but instead we broke to the upside. I mean, and that was the more probable scenario because it is obviously a bull flag, but this still doesn't really count as a major breakout. This pattern is pretty small, but at this point the probabilities favor that we'll have this pole go up. So I'm expecting Bitcoin in the short term to get around to 92,000 before deciding what to do from there. But I'm not betting on that. Gold surging higher. we are above 3,400, and I added to my short. Gold to me is in a euphoric stage after already being historically elevated in price when you compare it to copper, home prices, you name it. This is getting dangerously expensive in my book, so I'm all too happy to be shorting at these nosebleed levels in this euphoric stage. It's not a very large position, but I don't mind benefiting from gold reverting to a little bit more normalcy whenever that happens. Oftentimes when the stock market is falling, the dollar index is going up, but the dollar index dropped today. And I wanted to note that we don't have a lot of like trend line support until maybe where these blue lines converge. I came up with these spots. This chart, where the view of this right now as I have it, dates back to 2019. The beginning of the chart really is March 2020, where we have that dip there, a peak, a fight zone. So I figure, maybe this is where we could have some converging lines. And so this area is around 94 in the DXY. Trump does want a weaker dollar. It helps the case for lowering rates, at least on the front end of the curve. In this kind of environment, the long end could go up, but I'm not sure how much it can go up from here without like blowing up, corporate debt, banks, and everyone that relies on debt not being so obscenely expensive. When you start looking at the future possible returns of gold, Bitcoin, the US stock market in this kind of a condition, I do expect a run to treasuries, especially right now while TLT is at this major trend low. I could be wrong, but the other truth of this is that if TLT like just drops precipitously from here, the one thing that you can guarantee is that the Federal Reserve won't let the banks, the commercial banks of the U.S. Blow up. They won't let all corporations go bankrupt, which is what happens if rates are too high. They take all the earnings. They get all of the payments coming into the company. They don't go into the company. They don't go into the earnings. They don't add to the value of the company. It just pays off the debt when debt gets this expensive. So any which way about it, the higher rates on the longer end of the curve their days are limited. They can't stay this high and or continue higher in this environment where we are. At least that's the way I see it, and remember, I'm just a guy with a crystal ball. One thing that could add to the case, typically longer yields, like the 10-year Treasury note yield, follows the price of crude oil, which today actually fell off to the downside. $65 a barrel seems to be on everyone's mind, and we almost hit that on Thursday. And Sunday's futures chart and today's candle are showing weakness. This is one of the biggest things to keep an eye on, because if we start seeing crude oil spiking along with all of the other things that are currently happening, we're headed into some financial disasters. I mean, we're headed into financial disasters no matter what at this point when you look at how everything is lined up. Anyway, the one chart that makes me believe that we are most definitely not actually headed into this like hyperinflationary environment or a complete runaway from the dollar, which would be like crazily inflationary. The break-even inflation rate is not seeing this at all. In fact, today's number, the chart doesn't really show it on the blue line, but we dropped a little bit today from 2.23 to 2.22. This market prices inflation expectations to average over the next 10 years. And ever since this whole tariff thing began, it has been going actually down, not up. Stay safe out there. Markets are going bonkers. That's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.